Good evening, everyone. Time for another silver update. This is the daily chart of silver overlaid over gold provided by netdania.com. You can click on the link below. Now, a divergence is forming up here. This is not a very large divergence, but it is significant. We can see that gold broke out of the saucer, cup and saucer, teacup, whatever you want to call it, teacup formation that I had pointed out earlier. That is a very, very bullish formation. It doesn't surprise me that we got a breakout to the upside. But with gold at 1287, silver is not following. Now, is this unprecedented? No, it's not. It's actually happened a number of times before, and certainly the width of this divergence is not very wide. You can see on the downside here, we had much larger divergences, especially with silver when it was falling, much lower than gold. But we're looking for a divergence on the upside. That's going to be different than a divergence on the downside. So you can see here, here's one that is an example back in July of last year. Gold took off, hesitated a little, and then pretty much rose steadily. But it took a full month. You can see a full month from about the beginning of July to a few days into August that silver finally took off. And you can see when it did take off, it rose very rapidly. But it didn't continue the rise because the smackdown in gold occurred. And then, even though there was a delay in the rise, you can see that immediately it reacted to the downside when gold was taken out. So that is the first example of this kind of divergence. Now there's another one over here that's even more important, because I think that that one was the precursor to a very significant rise, and I think we're in a similar situation. So you can see back in the beginning of August of 2010, actually late July, you can see that blast off from the bottom in gold. Pretty much a straight line rise all the way up to this point here. But you've got this sideways movement in silver all the way out to the third week in August, and then you get that blast off in silver where silver actually catches up, meets gold, and then they both fall back. Silver rallies above gold, they both fall back, and then silver simply explodes to the upside. And you can see in this move here where gold moved from about 1307 to about 1575, so about a $250 move in gold. That was accompanied by a move from about 26 bucks to 48 bucks. So we got a couple $100. What is that in gold? That's 250 on top of 1310. We're talking about maybe a 20% move in gold, but nearly 100% move in silver. So that's how it works. Silver is late to the party, but when it gets there, things go crazy and it goes wild. So I'm guessing we're looking at something like that scenario happening here. And we have to look at what's coming on the news screens. I'm going to look at this debt chicanery that came out today, and it's absolutely stunning. But before we do that, I want to look at the newest saddle tramp, and that was posted on Godlike Productions. You have to remember that the weight of someone's analysis is based upon what they say, and of course how their predictions are fulfilled. But this guy seems to have a lot of followers. A lot of people think that he's saying something valuable. So he came out today and concluded that this is a important, we're at an important point in this process. I'm not going to read the whole thing. You can read it yourself. I'll start here with the fourth ring. He's making an analogy about the failed ring at the Olympics, and he's talking about the stages of this unfolding collapse. So we'll start reading here. The fourth ring, where the players are rolling a snowball into a mountain. Established manufacturing and exporting nations will be presented with a quandary at this point. Do they take up the policy abandoned by the Fed and do massive liquidity injections in the face of potential of hyperinflation and revolution in their overpopulated countries, or do they follow the example of the Fed and soak up the wealth of their newly created middle class, millionaires, and billionaires? I believe they will follow the Fed into the initial deflation of this plan, knowing that the deflation won't last forever. They're privy to the end game of this plan, even if the masses are not, so they will knuckle down, bash some heads, steal the wealth, and allow the defaults just like everyone else, because, simply put, it's just that time. So there will begin massive loan defaults and deflation in the manufacturing hub of Asia, and that contagion will spread westward in an already over-leveraged Europe. Stocks will continue to slide, interest rates around the world will continue to rise, liquidity and paper wealth will continue to evaporate, credit will become increasingly hard to find, and then one or more nations in Europe will require another bailout. But that bailout will be denied, not in so few words, of course, and instead will become a bail-in. The last of the hot money will flee Europe and Asia to the perceived safety of U.S. treasuries, which has so far been relatively insulated from the effects of the building economic crisis. Then when Europe lets loose the ogre of deflation, the derivative markets will come into focus. Rumors of default on derivative contracts will surface. Gold and silver will seemingly disappear from vaults around the world, and there will be a run on the COMEX ending in COMEX default. Then the crisis will wash up on the shores of the USA, and by then it will be a juggernaut. The fifth ring, where the players stand ready with locked hands to take a bow. So now the spotlight falls on the stage of the fifth ring, and the contagion of the world economic collapse has finally washed ashore in the USA. The Fed will stubbornly say this is all going according to plan. Money will flee from other markets to treasuries, and they will say the dollar has been insulated. It will look like they are ready to proclaim the peak of the crisis. The trumpets will blare that the dollar has endured, and then the COMEX will default. And perhaps a major business important to the infrastructure of the U.S. will run out of money, or a large bank will come into focus and claim they have enough reserves to survive the end of the world. Then around 3 days later, they will fold their tent like Bear Stearns or Lehman Brothers. Precious metals and commodities will take a moonshot. Interest rates will skyrocket, and the hot money will now begin to flee out of treasuries. So falls the ogre of deflation to the genie of inflation. Again, Christine Lagarde's terminology, or rather, hyperinflation. And now the real pain for the average member of the world's population begins. The Fed may well reverse the taper course at this point, but it will be perceived as a panic move, and the markets will continue to fall. Interest rates will continue to rise. Now, instead of the word deflation falling from the lips of the financial pundits, the word hyperinflation begins to be whispered in back rooms over whiskey sours and G&Ts. Until finally, when the pain is bad enough and the masses are screaming for someone, anyone, to save some small part of the value of their house and their life savings, someone, somewhere will mention the words economic reset. And the Hegelian love story I talked about in part 1 of the grand finale will be fully underway. And while the prospects are bantered about at the world's financial forums, China will back the yuan with gold that has recently more than quadrupled in value, and possibly the promise of their rare earth mineral reserves as well. This move will force their hand, and so it will begin. The great currency reset will be underway. The dollar will lose hegemony as the world reserve currency, and the five-ring circus will be complete. And the fat lady will sing over America as night falls on the greatest country the world has ever known. Another great experiment failed. For details about the currency reset plan I see happening, please see the section Problem, Reaction, Solution, etc. So that is stunning. We'll see if he's right. He's been fairly right on so far. Very interesting. But I want to take you over to this debt chicanery. Now, this is fascinating to me. You can see on the front page of Yahoo, it's right here. U.S. House passes clean one-year debt limit increase. So my first thought is, okay, well, let's take a look here and see, first of all, what the bill was and what the new limit is. U.S. House of Representatives, by a narrow margin on Tuesday, passed a clean legislation raising the government's borrowing authority for 1 year in order to avoid a default that was looming at the end of this month. By a vote of 221 to 201, the House passed a bill adhering to President Barack Obama's demand that it have no unrelated conditions attached. With House passage, the bill now goes to the Senate, where debate could begin on Wednesday. Only 28 of the House's 232 Republicans voted for the measure, leaving Democrats to provide most of the votes for passage. So interestingly here, we're told we get a new one-year debt limit increase, but we're not told what the new debt limit is. We're not told what the bill is. So I did some digging here. Now here's some very interesting stuff. First of all, I always pull up debt to the penny. I always take the date and go 1 year back, and you can see February 2011 to February 2013 to February 2014 on the 11th. You can see the debt was $16.489 trillion. Same date in the future, $17.258 trillion. So we're talking about $800 billion. Debt still going up. Deficit is remaining nearly $1 trillion. Not much change there. Now, let's look at this entry for Wikipedia. This is History of United States Debt Ceiling. Because I was looking for the history of the debt ceiling increases. You can see here is a table of historical debt ceiling levels. And you can see it here, debt ceiling in billions of dollars, change in the debt ceiling, billions of dollars, all the way back to the 40s. You can see it here. We go from, sorry, running out of battery. So we go from 1990 all the way up to the present. I'm going to plug in. Hopefully I don't lose my sound here. Bear with me. All the way up to the present, but when we get near the present, you can see something very interesting here. On February 4th of 2013, you can see debt ceiling suspended. Then we get a vote, and we get a new debt ceiling of $16.7 trillion. Then, you remember the last debt crisis we got on October 17th, suspended. Now we get this interesting term here that is entered in for the 7th of February this year, auto adjust. Interesting. What does that mean? What does that mean that the debt ceiling now auto adjusts? Well, I went to Google and I did a whole bunch of searching to try to find an article that told me more than what the Yahoo article says, and I came across this article, and this is CNBC. House passes debt ceiling increase with no add-ons. If you scroll through this article, you find so we're looking for the actual number. We find this statement. The measure does not raise the debt limit by any set amount, but would suspend it through March 15th, 2015 to allow Treasury to borrow the money it needs to pay bills like Social Security benefits, payments on government debt, and checks for federal workers. So that's a very interesting statement there. They're not raising the debt ceiling. There is no debt ceiling. They are moving from a number to a time. Very, very interesting. They're not telling you that. You can see on the Wikipedia, you've got footnote 31 for the last one that says auto adjust. So you think, well, let's go look up footnote 31. Oh, there isn't a link. There's just this reference. Jack Lew urges Congress to raise the debt limit before February 7th. Tax notes today by tax analyst. So very, very interesting debt chicanery going on, and everyone's in on it. It's crazy. This is an old article. Did the deal allow the president to set the debt limit from now on? Very interesting. We're seeing a lot of consolidation of power in the executive. So we're really not sure what this means, but it's probably not a good thing. Last thing I wanted to read you is this statement from the grand finale from Saddle Tramp, and an ominous statement. We'll see if I can find it here. He's talking about the Depression. The collapse you and I will witness to will be the worst in the history of the world, at least the history we know. It has no other way to go. If you want to know how much worse this will be than the Great Depression, simply look at the meteoric rise in world population. And he says that this depression will be 10 times worse than the Great Depression. Absolutely stunning. It's clear to me that the House knows something big is coming. They're playing debt chicanery. They don't even want to tell us a new debt limit. They're just setting a time frame. Things are getting ready to blow. They're clearly getting ready to blow in gold and silver. And we'll talk to you next time.